Hey everyone, and welcome. Ever looked at a stock and just wondered, is this actually a good deal? It's a question every single investor has to ask. Well, today we're going to break down the one key tool that helps you find the answer. Let's get right into it.
All right, first up, let's talk about a stock's real price, because as you're about to see, it's not always what it looks like on the surface.
Okay, so picture this. You're looking at the market, right? You see one stock for 10 bucks and another for 100. It's just so easy to think, oh, the $10 one is the cheap one. But is that really the whole story? I mean, how do you actually know if you're getting value for your money?
And here's the thing that trips a lot of people up. It sounds crazy, but a $100 stock can absolutely be cheaper than a $10 one. See that price tag? It's just one piece of a much bigger puzzle. What really matters is what the company earns. That pricey-looking stock might be a total bargain if its profits are through the roof, while that $10 stock, it could be way overpriced if it's barely making a dime.
So how in the world do we solve this puzzle? Well, lucky for us, investors have this awesome tool that cuts right through the noise, and it's called the P/E ratio. Let's dig in and see exactly what it is.
So, the price-to-earnings ratio, or just PE for short, this is pretty much the go-to metric for figuring out a stock's value. But that definition sounds a little textbooky, right? Let's break it down into plain English. The main idea is actually super simple. Okay, this right here, this is the most important thing to remember. The PE ratio literally tells you how many dollars you have to pay for just $1 of the company's earnings. Think of it like a price tag, but instead of buying a product, you're buying a dollar of profit. So if a company has a PE of, say, 15, that means you're paying 15 bucks for every single dollar it earns. See? Pretty straightforward when you think of it that way.
But here's the catch. A PE ratio all by itself doesn't tell you much. Its real magic comes out when you start comparing it to other things. Let me show you what I mean.
Let's say you're looking at two companies, both in the same business. You've got Company A with a PE of 15 and Company B with a PE of 25. Well, for Company A, you're paying $15 to get $1 of their earnings. But for Company B, you've got to fork over $25 for that exact same dollar of earnings. Now, if everything else is equal, which one sounds like the better deal? Yeah, Company A, right?
And it's not just about comparing different companies. You can also use the PE ratio to compare a company against, well, itself. If Company A had a PE of 20 last year, but today it's down to 15, that might be a sign that the stock is a better bargain now compared to its recent past. It's a great way to get some historical perspective.
Okay, now this is where it gets even more interesting, because it turns out there isn't just one PE ratio. It really depends on when the earnings happened. Are we looking back in time, or are we trying to peer into the future? And that brings us to what I like to call the two flavors of PE. First, you've got the trailing PE, which is all about the past. And second, there's the forward PE, which is all about what's coming next.
And this difference is super important. The trailing PE, it uses the company's actual earnings from the past 12 months. These are real numbers, they're in the books. It's based on historical fact. The forward PE, on the other hand, uses analyst estimates of what the company is going to earn over the next 12 months. It's basically an educated guess about the future. It can be incredibly helpful, for sure, but you gotta remember it's a prediction, not a guarantee.
All right, I know we've thrown a lot at you pretty quickly here, so let's just take a moment and recap the absolute must-know takeaways from all of this. Okay, 3 key things to lock in. First, at its core, the PE ratio is just the price you pay for $1 of a company's profit. Simple. Second, its true power isn't in isolation. It's a comparison tool. You use it to weigh a company against its rivals or against its own history. And third, don't forget the 2 types. Trailing PE uses hard data from the past, while forward PE is all about future predictions.
So, we've seen how the PE ratio is a fantastic tool for sniffing out value. But that leaves us with one huge question, doesn't it? Is a lower PE ratio always the better deal? Or could a super low PE sometimes be a trap? Something to think about. Thanks for tuning in.